The effectiveness of trickle-down economics, the idea that tax cuts for the wealthy and businesses will eventually lead to benefits for everyone, including the middle and lower classes, is a highly debated and controversial topic. There are several arguments for and against it, and whether it works largely depends on your perspective and how you measure success. Here's a breakdown. Arguments for trickle-down economics stimulates investment and job creation. Proponents argue that when businesses and wealthy individuals have more disposable income, thanks to tax cuts, they are more likely to invest in expanding their businesses, hiring more workers, and increasing wages. This, in turn, should benefit the broader economy as jobs and wealth trickle down from the top. Increases capital formation. By lowering taxes on capital gains, supporters say it encourages investors to put more money into the stock market, real estate, or new ventures. This influx of investment could, theoretically, lead to more innovation, business growth, and job opportunities. Global competition. Advocates of trickle-down economics argue that reducing corporate tax rates makes a country more competitive in the global market. If companies face lower taxes, they might choose to invest or do business in that country, rather than one with higher tax rates, creating more jobs and growth. Arguments against trickle-down economics. Wealth inequality. Critics argue that trickle-down economics tends to increase wealth inequality. Instead of benefiting the broader economy, tax cuts for the rich and corporations often result in the wealthiest individuals accumulating even more wealth, while middle and lower-income workers see minimal benefits. Over time, this can exacerbate income and wealth inequality. Minimal impact on wage growth for average workers. In practice, wages for the working class have often stagnated, even during periods of economic growth attributed to trickle-down policies. While businesses may see record profits, those profits don't always lead to higher wages or more job opportunities for everyday workers. Instead, companies may use the tax savings for stock buybacks or dividends to shareholders, which disproportionately benefits the wealthy. Doubtful impact on economic growth. There's debate over whether the tax cuts actually stimulate the economy as promised. For example, during the Reagan administration in the 1980s and the Trump administration's 2017 tax cuts, GDP growth didn't consistently outpace growth under more progressive tax regimes. In fact, some studies suggest that trickle-down economics leads to increased deficits rather than sustained growth, as tax cuts for the wealthy and businesses reduce government revenue without necessarily producing the promised economic benefits. History of underperformance. When looking at the history of trickle-down policies, results have been mixed. In the 1980s, tax cuts under President Reagan did lead to some initial economic growth, but the wealth disparity between the top and the bottom of the income ladder widened considerably. Similarly, the 2017 tax cuts under President Trump led to short-term growth but did little to move the needle on long-term prosperity for working-class families. Instead, they contributed to a ballooning national debt. Focus on supply, not demand. Critics argue that trickle-down economics focuses on the supply side of the economy, encouraging investment and production, while neglecting the demand side. In order for the economy to grow sustainably, people need to have the purchasing power to buy goods and services. Without increasing the incomes of the middle and lower classes, demand remains weak, which limits overall economic growth. What the research says. Empirical evidence. Many economists point to empirical data showing that trickle-down economics often doesn't lead to the widespread prosperity that its proponents claim. A study from the International Monetary Fund in 2015 found that tax cuts for the rich are less effective at stimulating growth than policies that target lower-income households, which tend to spend more of their income, thus boosting demand. Similarly, the Congressional Research Service found little correlation between tax cuts for the wealthy and economic growth, showing that top-down tax cuts have little effect on long-term GDP growth. Effect on wealth inequality. In many cases, trickle-down economics has contributed to greater income inequality. A 2017 study by the Institute on Taxation and Economic Policy found that the richest 1% of Americans benefited far more from the 2017 tax cuts than the middle or lower classes. Most of the economic benefits from these cuts went to the wealthy, rather than trickling down to the rest of the population. Real-world examples. Reagan era, the 1980s. When President Ronald Reagan cut taxes on the wealthy and corporations, the economy did see growth in the short term. However, the benefits of this growth were not equally distributed. The wealthiest Americans saw huge gains, while middle-class wage growth remained sluggish. Income inequality grew during this period, and the national debt increased significantly. Bush era, the 2000s. During George W. Bush's presidency, tax cuts for the wealthy and corporations were implemented, but these cuts did not lead to the kind of broad-based prosperity that was promised. Instead, the 2007 to 2008 financial crisis caused a severe recession, and income inequality continued to rise. Trump tax cuts, 2017. The Tax Cuts and Jobs Act of 2017, which heavily favored corporations and high-income individuals, did not result in the kind of trickle-down benefits many expected. While corporate profits soared and stock buybacks increased, wage growth for the average worker remained relatively slow. Additionally, the cuts contributed to a growing budget deficit and did little to reduce income inequality. Does trickle-down economics work? It depends on how you define work. In terms of overall economic growth, trickle-down policies have historically contributed to short-term growth, but have not necessarily led to broad-based, sustainable prosperity. In terms of wealth distribution, the evidence suggests that trickle-down economics tends to disproportionately benefit the wealthy and corporations, exacerbating inequality rather than helping the middle or lower classes. In terms of creating jobs, trickle-down economics often fails to create the number of quality jobs promised, especially for those at the lower end of the income scale. So, in short, the evidence suggests that trickle-down economics does not deliver on its promises of shared prosperity for all. Instead, it tends to concentrate wealth at the top without providing substantial benefits for the rest of the population. Many economists and policy experts now argue for a more demand-side approach, where investing in education, healthcare, and wages for the middle and lower classes leads to more sustainable growth. What's your take on it? Do you think the trickle-down model holds any value, or do you feel it's outdated?